Hi friends, Simit here from InformedTrades.com. In today's video, we're going to talk about high-frequency trading firms and how some of them use an illegal tactic known as quote stuffing to create risk-free trading opportunities. Let's get started.
Okay, key points. First is high-frequency trading firms, HFTs. They pay to get information first, so they basically have an arbitrage opportunity. So they are paying. It's not only that they have faster computers, but that they're paying to get the information first before it's actually distributed to you. Some HFTs illegally use quote stuffing to create more and better arbitrage opportunities. There's something called latency arbitrage, which they use quote stuffing to increase the amount of time between when they get an order and when an order is sent to many other people. That is a tactic that is illegal. Citadel, a high frequency trading firm, has gotten fined for it. For traders and investors, for regular people, quote unquote, who don't have a direct market access feed, for probably most people who are viewing this, this results in a worse execution price for you. However, it's a really small percentage. We're talking less than 0.2% difference in execution price. So if you're a longer-term investor, weeks, months, not even that long-term, weeks or months, it's not that significant in terms of the immediate price. Where it is perhaps more of an issue is that it creates structural problems in the marketplace where the real price of security at any given time is unclear, and this can cause liquidity to dry up. And some people attribute that to the flash crashes that have occurred over the past 5-6 years. Let's delve into those points a little bit deeper. Okay, so the first thing to really understand how high-frequency trading firms are creating latency arbitrage as a risk-free profit opportunity is to understand how they have a structural advantage in the market. Okay, so basically there are 12 exchanges that actually buy and sell and execute the order. There's also a bunch of what are called dark pools that are also function essentially as exchanges, although the difference is they're a little more anonymous in terms of you don't see the exact order size. You just see that an order was placed and that trades were exchanged. So those are 12 isolated little regions, you could say, that all trade stocks. There's something called SIP, which aggregates those 12, and the dark pools, and creates what's called the NBBO, which is the National Best Bid, Best Offer. So that's where, whenever you're watching CNBC or if you're on, a website, Google Finance or whatever, and you're looking at the stock prices, you're seeing the NBBO. And what that is NBBO is created by SIP, and that's looking at all those regional exchanges as well as the dark pools and finding the best price. So on one exchange, you might have Apple trading at, or you might see orders for Apple trading at $500. Another place, $499.75, etc. Of course, I'm just, in reality, there's always two prices. There's the bid price at which traders can buy. There's the ask price at which traders can, other way around. Traders, you hit the bid, you buy the bid, or you sell the ask. So the NBBO is the aggregate of those, and it finds the best one. And that's what you're seeing on Yahoo Finance or CNBC or whatever you're watching, Bloomberg, etc. And that goes to your retail broker. So the NBBO goes to the retail broker. If you log into your trading account with Scottrade, E-Trade, whatever, that's the price you're going to see. Now, high-frequency trading firms, and individuals can do this too, but really high-frequency trading firms are subscribing directly to the exchanges. So they're not waiting. They're getting the price at the same time that the SIP gets it. So they can essentially create their own national best bid, best offer. They can say, all right, exchange 3 over here has the best price. So let's just, they can see that sort of before the information gets to the retail broker. And this time difference, because they're getting the information at this step, right where the SIP is aggregating it, it gets to you before the retail broker. The other important point to note is that high-frequency trading firms, often many of them, the good ones, and the market is very competitive these days, can do the aggregation work faster than SIP does, right? So, even though they're essentially doing the same thing that the SIP feed is doing, they are doing it faster. And they are also able to get it, they're able to get it and respond right away, whereas you sort of need to wait for the aggregation and wait till it gets to your broker. So it's really cutting you off, and it's also faster than SIP, generally speaking. Okay, also high frequency trading firms can trade directly with the exchanges. So in addition to, just aggregating the prices and seeing where the best price is, and what the best price is, they can say, all right, exchange 3 has the best price, or they can see exchange 2 is lagging a little bit, meaning that it's behind, it's slow. So they can quickly order, and they can see all these orders coming in. They know what the NBBO is going to be, and they can sort of see how demand is shaping up, and they can see which prices are slow to move. Um, if they see an order coming in from a retail broker that's going to be to buy at $100 a given share, they can jump in front of that essentially because they can see that order. Quote stuffing is the practice of sending orders to false orders. Basically, quote sending is sending fake orders to the exchanges where you send an order to buy a stock at $10 and then you immediately withdraw it. So that it cannot actually be executed. It's sent and then it's taken away. It's basically, if you think about it, it's a form of spam or a denial of service attack in computer networks, if you're familiar with that, where you're sending a lot of information that these exchanges need to process, but ultimately they're not real orders. And this is an illegal practice. It's illegal to put an order that doesn't have real buying and selling intent. The impact of this is that it creates more information that needs to be processed and sorted through, which slows down the ability of the SIP to aggregate and create the national best bid offer. So it slows down, it creates greater latency between when high frequency trading firms, which they'll know which orders are real and which ones are the quote stuffing, the sort of the fake prices, the orders that they're sending. It creates a greater difference between the times that they see and when SIP is aggregating all those fake orders and deleting them and then sending it to the retail broker. So the more time there is between when high frequency trading firms see orders and place trades and between the SIP aggregating the national best bid best offer, that creates more latency, which creates more risk-free trading opportunities, essentially risk-free, right? So if the NBBO that SIP creates sends out a price of $100 on a given stock, and a high frequency trading firm knows that that's the late price, meaning it knew that the SIP was going to come to that conclusion, 2 minutes before it did. Not 2 minutes, but really we're dealing with milliseconds here or seconds. But that's enough time for the high frequency trading firm to, sell into that or to anticipate that order and trade exactly it. Or if it sees exchanges that are offering a different price, it can focus on that and then sell at $100 if $100 is the higher price. So if it sees an exchange selling at $97, or reality, we're dealing with very small increments here. So if it sees an exchange selling at $99.99 and it knows that an order is going to reach the NBBO at $100, it can quickly buy there and sell at $100. That's sort of the basic idea. They can target those exchanges. They can create greater latency through quote stuffing, which is an illegal tactic. Citadel, a high-frequency trading firm, one of the biggest, most profitable ones. They're the most visible example of getting fined by the SEC for quote stuffing. Okay, now, like we mentioned in the introductory slide, high-frequency trading doesn't have that much of an impact. If you're thinking as an individual trader or if you got money in a mutual fund or whatever, it's really creating a very, very small difference in the price that you get as a trader. So for instance, you put an order on through your online broker, a high-frequency trading firm is going to be able to see that order and is essentially going to be able to jump ahead. And because they're jumping ahead and cutting in line, so to speak, cutting in line, I think is the preferred analogy. That ends up in you getting a slightly worse price, right, than you could. So really what they could do is, buy it. If you have an order to buy it $100, they can buy it at $99.98 if they see that price, and then sell to you at $100 and make a 2 cents risk-free profit. And they can do this more and more if the latency is greater, which they're doing through quote stuffing. But this is really, in that example, 2 cents, 1 cent, and that really is the kind of difference we're talking about here. It's pretty insignificant, right? So if you're an investor and, let's say that there weren't high-frequency trading firms, and you might have gotten executed at $99.99. But because of high-frequency trading firms, you're getting executed at $100 a share. So, let's say you put on an order for 100 shares, that means you've lost $1, right? And 100 times 100, that is $10,000. So on a $10,000 order, high frequency trading firms are costing you $1. And let's say the same thing happens when you sell. So let's say it costs you $2, or even let's say it's even more. Let's say it's $3. That's pretty small. Definitely the commission you're paying, the underlying market of whether the stock price goes up and down is still far and away the biggest factor. The real issue, though, is over the past 5 or 6 years, we've seen flash crashes where the market stops trading, where you see really weird spikes in the market. There, all these orders suddenly disappear, and the stock drops, $50. And even big name stocks, we've seen this type of stuff in Apple, which is the largest market capitalization in the world. And a lot of that behavior is driven by by high frequency trading firms and quote stuffing, where it's because the HFTs are trading on these separate exchanges, they're front running the price, they're sending fake orders. It's unclear often what the real price is, especially because of quote stuffing and because of all these different exchanges, the dark pools and things like that. So trades are spread out. Liquidity is fragmented, is what they say when the trades are spread out over a lot of different exchanges and dark pools. You have quote stuffing. It becomes unclear what the real price of a stock is, and that causes buyers and sellers to withdraw. It causes flash crashes, things like that. And that is the real risk of high frequency trading firms, the structural uncertainty in the market. The latency arbitrage may be unfair. Some people say it's you can go ahead and try to pay the exchanges, going back a couple slides, you can pay the exchanges for a direct connection. You can get a really fancy computer set up. You can get your computer situated, as close to the exchange as possible so that you're, getting very competitive. You're getting information at the same time the high frequency trading firms are. So you can do all these things. So a lot of people say it's not really unfair. And that's sort of subjective. Even if it is unfair, the immediate cost is really not significant. Where I think the bigger argument is through quote stuffing, which is illegal. It's really unclear what the real price is, and that's sort of the larger issue. And the structural risk, it's in a very unfortunate scenario, could result in a market crash and complete chaos. And that's sort of where a lot of people who are concerned about high frequency trading, that's where their concern is coming from. That's about it. This is a fairly complicated topic, and there's actually a lot more to it. There's a lot of other games that high-frequency trading firms play and things like that. This is sort of a broad overview of latency arbitrage, which is one of their simpler, more straightforward tactics that has an immediate consequence and impact on the rest of the market, including the share price. Any questions you have, anything you want to add, join us at informedtrades.com. Best of luck in your trading and investing, and we'll see you next time. Take care.